Today is March 22nd, 2026. I am looking at Kitco right now as I record this. Silver spot bid 67.69, down $5, down 6.88% in a single trading session. Gold has just posted its biggest weekly loss in 6 years, down 10% in 5 days. And the reason every financial outlet is giving you for this collapse is Iran war escalation. Let me say that again slowly, so it lands properly. War is actively escalating in the Middle East. The Strait of Hormuz, through which 20% of the world's oil supply passes, is commercially disrupted, and silver just crashed nearly 7% in one day. If you have been stacking silver for any length of time, your brain right now is doing one of three things. You are panicking and thinking about selling. You are confused because everything you know about precious metals tells you this should not be happening. Or you are watching the price and wondering whether this is the worst possible time to add to your stack, or the best. I'm going to answer all three of those directly in this video, but first I need to give you a number that Kitco published 2 days ago on March 20th that almost nobody in the silver community is connecting to today's price crash. China imported nearly 800 tons of silver in January and February of 2026 alone. That is a record high. The largest industrial silver-consuming nation on Earth bought silver at a pace it has never bought before, in the exact same months that the paper price on COMEX was crashing. The paper market sold $5 worth of silver today. The physical market bought 800 tons in 2 months at a record pace. One of those signals is telling you to panic. One of those signals is telling you something completely different. Understanding which one reflects the actual structural reality of the silver market is what this entire video is about. And by the end of it, you will have a framework for reading these two signals that most Silver Channel viewers simply do not have. Let us break it down completely. Let me start with the paradox, because if you do not understand this, you will misread every major silver price move for the rest of your stacking career. The conventional wisdom is simple. Geopolitical crisis creates fear. Fear drives money into safe haven assets. Gold and silver are safe haven assets. Therefore, crisis equals metals up. And this conventional wisdom is not entirely wrong. It describes what happens under certain narrow monetary conditions. What it leaves out is the transmission mechanism, the chain of events that sits between the geopolitical trigger and the actual price of silver. Here's the complete chain of what happened starting March 2nd, when Operation Epic Fury began and US and Israeli strikes hit Iran. Oil spiked 13% in the first hours of trading. That is the immediate response to a Strait of Hormuz disruption. 20% of global oil supply is at risk. Oil gets priced accordingly. Oil spiking immediately feeds into inflation expectations. Every business that burns diesel, every manufacturer that uses petroleum-derived inputs, every logistics company that moves goods, their cost structures just went up. The bond market priced this in within hours by pushing treasury yields higher. Here is where it connects to silver. Gold and silver trade inversely to real interest rates. When treasury yields rise, when the return on a safe government bond increases, the opportunity cost of holding silver goes up. Silver pays you nothing. A treasury bond now yields more. Rational portfolio math says rotate out of the non-yielding asset into the yielding one. This is not a conspiracy. It is arithmetic running through millions of institutional portfolios simultaneously. Simultaneously, rising U.S. rate expectations strengthened the dollar. The dollar index moved up sharply, and because silver is priced globally in dollars, a stronger dollar mechanically compresses the dollar price of silver. The same physical ounce requires fewer dollars to purchase when each dollar is worth more. Complete sequence. Iran escalation pushed oil up. Oil pushed inflation expectations up. Inflation expectations pushed rate expectations up. Rate expectations pushed the dollar up. The stronger dollar pushed silver from $96 on March 2nd down to $67.69 today, March 22nd. This is not new. This exact sequence played out in October 1973 after the OPEC oil embargo. Gold spiked on the initial shock and then pulled back for months while the inflationary mechanics ran through the monetary system. Investors who looked at that pullback and concluded gold had failed as an inflation hedge missed a 2,300% return over the following 9 years. The real move did not start at the moment of the shock. It started when the market realized the inflation created by the oil shock was structural and permanent, and that the Federal Reserve could not fight it aggressively without destroying an economy already burdened by debt. Sound familiar? It should, because the U.S. is currently rolling over $9.2 trillion in federal debt this fiscal year at interest rates between 4 and 5%. Annual interest payments have crossed $1 trillion, more than the entire defense budget. The Fed's ability to fight oil-driven inflation by aggressively raising rates is constrained by a debt load that makes sustained high rates economically dangerous. That constraint is what transforms a temporary suppression mechanism into the setup for the next leg up. But we are getting ahead of ourselves. First, let me explain what 800 tons actually means. On March 20th, 2026, Kitco News published a report with the following headline: China silver imports hit record high, nearly 800 tons, in January and February. I want to spend real time on this number because it is the most important data point in the silver market right now, and it is being almost completely ignored in the conversation about the price crash. 800 tons. Let me put that in context. Global annual silver mine production is approximately 25,000 to 26,000 tons per year. China imported roughly 800 tons in the first 2 months of 2026 alone. That is approximately 3.1% of total global annual mine supply purchased by one country in 60 days on the import side only, not counting China's own domestic mine production. Annualized, that pace represents nearly 4,800 tons per year in Chinese silver imports alone. That would be a historically extraordinary level of import demand from a single nation. Now here is what makes this number extraordinary specifically in the context of today's price crash. China did not buy 800 tons of silver because it was cheap. Silver was trading well above historical averages during January and February. China bought 800 tons of silver because China needs 800 tons of silver for reasons that are structural, industrial, and policy-driven at the highest levels of the Chinese government. Let me give you the 3 demand drivers behind that number. The first is solar energy. China has been installing solar generating capacity at a pace with no historical parallel. In recent years, China has added more solar capacity annually than the rest of the world combined. Each gigawatt of solar panels requires approximately 15 to 20 metric tons of silver for the photovoltaic cell contacts and conductive pathways. China is adding tens of gigawatts per year. That represents hundreds of tons of silver consumed annually by solar alone. And China's government has made this build-out a national energy independence priority. This demand is not discretionary, and it does not respond to COMEX paper price fluctuations. Industrial buyers who need silver to build solar panels buy silver when they need it. The second is electric vehicles. China produced approximately 9 to 10 million electric vehicles in 2025, making it the world's largest EV market by a significant margin. Each modern electric vehicle uses roughly 25 to 50 grams of silver in battery management systems, charging contacts, power electronics, and sensor arrays. At 10 million vehicles, that is 250 to 500 metric tons of silver consumed by Chinese EV production annually. And Chinese EV production is growing year over year as both domestic adoption and export markets expand. The third is electronics and semiconductor manufacturing. China is the world's largest manufacturer of consumer electronics, industrial control systems, and increasingly semiconductor components. Silver is used in soldering, electrical contacts, and conductive elements throughout virtually every category of electronic manufacturing. This demand is diffuse and harder to isolate precisely, but it is enormous in aggregate and it grows with Chinese manufacturing output. Now combine those 3 structural demand drivers with one critical policy development. China has been restricting silver exports as a strategic resource. The Chinese government has classified silver alongside other critical industrial metals and implemented export controls limiting outflows. The surplus silver that used to flow from Chinese domestic supply outward to supplement global markets is no longer available at the same volumes. 800 tons of silver imports in 2 months is China saying, loudly, in the language of actual tonnage, that it needs more physical silver than its domestic supply and restricted export policies can provide. That is a demand signal of genuine structural weight. It does not care what the COMEX algorithm printed at 3:57 p.m. on March 22nd. This is the conceptual framework that separates stackers, who make good long-term decisions, from stackers, who react emotionally to price screens. The paper market and the physical market are 2 different things, run by different participants, responding to different signals, and they diverge, sometimes dramatically, before eventually reconnecting. The paper market is COMEX. COMEX silver futures are financial instruments. The participants are hedge funds, commodity trading advisors, algorithmic systems, speculative traders, and institutional desks running macro strategies. Historically, somewhere between 95 and 98% of COMEX silver futures contracts never result in physical delivery. They are open to take a view on price direction and closed before delivery becomes relevant. When a macro signal fires, oil up, dollar up, rates up, COMEX algorithms respond within milliseconds. They do not pause to check whether China just imported 800 tons of physical silver. they execute the model. The result is a $5 intraday drop in the paper price of silver that reflects financial positioning, not physical supply and demand reality. The physical market is something else entirely. It is the 800 tons of silver moving through shipping containers from global suppliers to Chinese industrial facilities. It is the refinery lease rates that recently spiked from under 2% to over 100%, a 50-fold increase reflecting genuine physical scarcity in the professional lending market. It is the COMEX registered inventory, the silver actually available for delivery, that has been declining persistently from its 2020 peak. It is the U.S. retail dealer who is seeing steady demand from stackers even as the paper price drops. These two markets are running on completely different logic right now. The paper market is selling because the Iran oil dollar rate's mechanical sequence says sell. The physical market is buying at record volumes because China's industrial complex needs the metal, regardless of what a COMEX algorithm thinks the price should be. The question every stacker needs to answer is this: when these two markets reconnect, and they always reconnect, because futures contracts eventually come due for physical delivery, and the paper price has to reflect what physical metal actually costs. Which direction does the reconnection happen in? Does the physical market come down to meet the paper price? Or does the paper price rise to reflect physical reality? History gives us the answer consistently. When physical demand is structural and growing, as Chinese industrial demand demonstrably is, and when COMEX registered inventory has been declining for months, as it demonstrably has, the reconnection happens upward. The paper price rises to meet the physical reality, not the other way around. The mechanism is delivery. When enough COMEX contract holders demand physical metal instead of rolling their contracts, the registered inventory has to cover those deliveries. If registered inventory is insufficient, the paper price must rise to attract new metal into the delivery system. That reconnection is not something you can time precisely, but the stacker who understands it is positioned correctly when it happens. The stacker who sold at 67.69 because the paper price was falling is not. Let me address the gold side directly because the headlines are dramatic and they deserve honest analysis. Gold losing 10% in a single week, its biggest weekly loss in 6 years according to Kitco, is not a small event, and I want to give you the honest reading of it rather than either dismissing it or catastrophizing it. Gold's sharp decline is driven by the same mechanical sequence I described for silver, but gold's larger percentage decline relative to silver on a weekly basis tells us something specific about the positioning dynamics in the gold market. When gold was surging earlier this year to record highs above $3,000, a significant proportion of that move was carried by speculative positioning, hedge funds, ETF momentum flows, and institutional trend followers who piled into gold because it was going up. When the macro narrative shifted with the Iran oil shock creating rate pressure, those leveraged longs became sellers simultaneously. Concentrated positioning amplifies moves in both directions. The gold-silver ratio right now, with gold somewhere around 2,800 to 2,900 and silver at 67.69, is sitting in a range that historically has preceded significant silver outperformance during recovery phases. The pattern is well documented. During initial stress events, gold tends to hold relative value better than silver because gold is predominantly a monetary metal with less industrial component. Silver, being half monetary and half industrial, gets hit harder on the industrial demand fear side during economic uncertainty. But when the monetary case reasserts itself, when the market concludes that the inflation created by the oil shock is structural and that the Fed cannot aggressively fight it against a $36 trillion debt load, silver historically closes the ratio gap with gold at a pace that surprises most investors. The 1979 to 1980 move saw silver outperform gold by more than 3-to-1 during the recovery acceleration phase. For a stacker who already holds gold, the ratio context suggests that adding silver at current prices relative to gold is historically well supported. For a stacker who holds primarily silver, the ratio context suggests patience is warranted. The ratio tends to snap back sharply once the monetary case becomes undeniable, and silver's underperformance relative to gold in the short term is typically temporary. Rather than telling you what silver will do, which nobody can do with certainty, let me give you 3 specific signals to watch over the next 30 to 60 days that will tell you whether the physical market is confirming or denying the paper price weakness. The first signal is COMEX registered inventory. This is the number of ounces of silver actually available for delivery in COMEX warehouses, the registered category, not the eligible category. Watch whether this number continues to decline even as the paper price falls. If physical buyers continue pulling registered silver out of COMEX warehouses despite lower prices, it tells you that real demand is absorbing the paper weakness and the correction is an accumulation phase. If registered inventory starts rising, meaning metal is being deposited back into COMEX at the lower prices, it suggests the physical market is softening and the paper weakness may reflect genuine supply-demand reality. You can track this number directly on the CME Group website. Check it weekly. The second signal is Chinese import data. We just got the January-February record of 800 tons. The next data release covering March will be published in April. If Chinese silver imports in March show continuation of that elevated pace, it confirms that the record buying was not a one-time anomaly, but a structural demand shift. If March imports drop significantly from the January-February level, it would suggest some of that buying was front-loading ahead of anticipated price moves rather than pure industrial demand. The third signal is U.S. retail premium behavior. Watch what happens to the premium on silver rounds, constitutional silver, and eagles at your dealers over the next 2 to 4 weeks. In a paper-driven correction with healthy underlying physical demand, premiums typically hold steady or even compress slightly as dealers offer modest discounts to move inventory that is arriving at lower replacement cost. In a genuine demand collapse, where physical buyers are also walking away, premiums fall sharply as dealers cut prices to move metal nobody wants. If you see premiums holding or starting to rise as spot price stays depressed, the physical market is voting differently from the paper market. That divergence between a falling paper price and stable or rising physical premiums is one of the strongest buy signals a stacker can observe. Based on what I am seeing across all three of these signals right now, the persistent COMEX drain we documented last week, the China 800-ton record import confirmation, and the premium environment at U.S. dealers, the physical market is not confirming the paper price weakness. Every signal from the physical side of this market is pointing in the opposite direction from what the COMEX algorithm printed today. I want to be completely transparent about what I am personally doing today, not what I think you should do, what I am actually doing with my own stack on the day silver crashed to 67.69. I am not selling a single ounce, and I am adding to my position. Here is my honest reasoning. The structural case for silver, the one built on COMEX drain data, Chinese industrial demand at record import volumes, lease rate dysfunction, and the fiscal constraints preventing the Fed from aggressively fighting oil-driven inflation, has not changed because of today's price action. None of the data I just walked you through has been invalidated by the $5 drop. The paper mechanics that caused the drop are temporary and documented. The physical demand that is running counter to the paper price is structural and growing. $67.69 silver with 800 tons of Chinese monthly buying running in the background, with COMEX registered inventory at multi-year lows, with lease rates that recently hit 100%. That is not a market whose structural bull case has ended. That is a market experiencing a textbook temporary suppression phase driven by the mechanical response of financial traders to an oil shock. Specifically, I have been adding silver rounds at current premiums because the premium environment is still relatively contained. You can find well-priced product in the $3 to $5 over spot range at reputable dealers. I have also been watching the constitutional silver market, the 90% junk silver coins, where I have been finding some reasonable pricing and where the premium tends to move last but fastest when the physical squeeze comes. I am not trying to catch the exact bottom. Nobody does that consistently. What I am doing is buying at a price level that the physical market data tells me reflects a temporary paper-driven disconnection from structural reality. If you are new to stacking and you are watching this crash and wondering whether you missed your window, you did not. The data says the structural case is intact. The China 800-ton number published 2 days ago is the physical market telling you that the most industrially active silver consumer on Earth agrees. Here is everything from today in one paragraph. Silver is at $67.69 on March 22, 2026. It fell $5 in a single session because Iran war escalation pushed oil up, which pushed inflation expectations up, which pushed rate expectations and the dollar up, which mechanically suppressed the paper silver price. Gold lost 10% in a week for the same mechanical reason. This is not a broken market. It is a documented, repeatable sequence that has played out in every oil shock since 1973. At the same time, China imported 800 tons of silver in January and February, a record high, driven by solar, EV, and electronics manufacturing demand that is structural, policy-supported, and not going away because COMEX had a bad week. The paper market is selling. The physical market is buying at record pace. These two things cannot both be right indefinitely. History says the physical market wins. Watch the 3 signals. Check COMEX registered inventory weekly. Watch for the March China import data in April. Monitor your dealer premiums. The signals will tell you what the paper price cannot. Use real data. Ignore the panic headlines. Stack accordingly. Happy stacking. Catch you in the next one.